What if I told you that the single most decisive analytical asymmetry between retail and institutional capital in the entire crypto market is no longer about access to information, no longer about speed of execution, no longer about regulatory positioning, but about something far more subtle and far more important: the cognitive ability to read what the on-chain data is actually saying in real time at the scale at which it streams across the public ledger every single second? Strong claim, I know. But before you scroll past this video, ask yourself this brutal question. How many times in the last 6 months has a screenshot of a single large XRP transaction crossed your timeline, triggered an immediate emotional reaction, fear, urgency, the impulse to sell, only for the supposed whale dump to turn out, days later, to be exchanged to custody internal rotation, or institutional cold storage rebalancing, or in some cases the exact opposite of what the surface alert suggested? That cycle is not random. That cycle is structural. The XRP ledger is one of the most transparent financial systems ever created, and that transparency, in the wrong analytical hands, becomes the most efficient psychological manipulation device in the entire market. The data is identical for everyone, the interpretation layer is not, and until very recently, the only entities deploying machine learning grade interpretation on the ledger were the institutions themselves, using that asymmetry to absorb retail panic at discounts and distribute into retail euphoria at premiums with surgical precision. While the crowd is reading whale alerts like horoscopes, something far more important is happening behind the curtain. Today, I'm going to walk you through how on-chain analytics actually works, why the AI-powered interpretation layer is the most important defensive technology retail has ever had access to, and what the documented patterns are quietly revealing about where this asset is heading. And the world, once again, is missing the signal. Welcome back. On this channel, we don't trade hype, we decode structure. Today, we are going under the hood of one of the most under-discussed frontiers in this entire space: the cognitive arms race between institutional analytics and retail interpretation on a public ledger, and how the democratization of AI-powered on-chain tools is finally beginning to narrow the gap that has cost retail trillions of dollars cumulatively over the last decade. No Moonboy fantasies, no emotional charts, just the mechanics of clustering, the documented patterns of accumulation, and the institutional positioning that retail has been trained to ignore. Before we go under the surface, this is informational analysis, not financial advice. Let's jump in. Let's start with the hard truth. 99% of XRP holders are interpreting on-chain data through a framework that was never designed for the scale, the obfuscation, or the institutional sophistication of the modern ledger environment. They see a single transaction. They assign it a single meaning. They act emotionally on that single meaning. And the institutions on the other side of every retail transaction are mathematically counting on exactly that interpretive primitiveness to fund their entry positions. Real on-chain analysis does not look at individual movements. It looks at clusters, behavioral signatures, temporal patterns, coinage, wallet relationships, entropy distributions, and consistency across thousands of correlated addresses simultaneously. That is work that no human eye can do at scale. It is work that requires machine learning. And for years, the only entities deploying that level of analysis at the level required to actually interpret the ledger were institutional hedge funds, professional trading desks, and the analytics arms of major banks. Retail was left reading whale alerts on social media, exactly the surface noise the institutions wanted them to react to. Here is what almost nobody on this platform is willing to say clearly: the XRP ledger's radical transparency is structurally unique in finance. Every drop of XRP that moves anywhere is etched into a public, immutable, real-time record. That transparency is a profound design feature, but it is a double-edged sword. In the wrong analytical hands, it produces panic. In the right analytical hands, it produces certainty. The difference is not the data. The data is open, public, and identical for every participant. The difference is the interpretation layer. And that interpretation layer, until the recent democratization of AI-powered on-chain tools, was the most asymmetric advantage in this entire market. David Schwartz has spoken at length about the design philosophy of complete on-chain transparency. Brad Garlinghouse has emphasized in interviews that public auditable settlement is one of XRP's core institutional advantages. They built a transparent system specifically to enable institutional-grade auditability. The institutions deployed sophisticated tools to read it. Retail was left reading aggregator dashboards designed for engagement metrics rather than analytical accuracy. This is not coincidence. This is convergence between system design and the rise of the analytical tools required to read it. And once you see the convergence, you cannot unsee it. Let me walk you through how AI-powered on-chain analysis actually works, because the mechanics matter and almost nobody explains them correctly. There are three core analytical techniques that, taken together, fundamentally change what is observable on the ledger. The first is clustering. Clustering algorithms ingest thousands of transactions per second across the entire ledger and identify behavioral fingerprints that indicate which wallets are actually controlled by the same underlying entity. To the naked eye, an institutional player might appear to operate 20, 50, even 100 different wallets. To a properly trained clustering algorithm, those wallets reveal their common ownership through the timing of funding events, the consolidation patterns of small balances into larger holdings, the choice of counterparties, the gas payment patterns, and a dozen other behavioral signals that no human analyst could meaningfully process across a ledger operating at this scale. The output is a map, a structural map showing that what retail interprets as broad participation is often a single institutional entity assembling a massive position across distributed addresses to avoid public detection. The second technique is coin age analysis. Every wallet and every UTXO on the ledger has a documented age, how long the coin sat before moving. When 5-year-old XRP suddenly moves, that is structurally and meaningfully different from when 1-week-old XRP moves. Old coins moving signal a fundamental long-term shift in holder intent. Recently active coins moving signal nothing more than routine market-making rotation. Without the age dimension, every transaction looks the same to the untrained eye. With the age dimension overlaid, transactions sort themselves into meaningful and meaningless categories with surgical clarity. The third technique is entropy analysis. Sophisticated institutional wallets, knowing they are under analytical observation, increasingly use obfuscation techniques, bouncing tokens through multiple intermediary addresses, deploying automated scripts designed to mimic human spontaneity, using transaction sequencing that looks superficially random. To a human reader, these techniques work. The bounces look like noise. To a machine learning algorithm trained on transaction entropy signatures, the obfuscation itself becomes the signal. Real human activity has a specific statistical fingerprint of irregularity. Natural human spontaneity is mathematically distinguishable from algorithmic mimicry. The camouflage strips itself away under proper entropy analysis. The disguise becomes the disclosure. Now ask yourself this brutal question. If institutional wallets have been quietly accumulating XRP across hundreds of obfuscated addresses throughout the entire recent down cycle, and the clustering data documents that exactly this pattern has been occurring, why has retail spent the same period emotionally convinced that nobody is buying? The answer is uncomfortable for the dismissal crowd. Retail was looking at the wrong analytical layer. Retail was reading aggregated surface alerts, while the structural accumulation was happening one layer beneath the surface, in a form that only proper clustering analysis could decode. The shark tier of the XRP rich list, wallets holding between 100,000 and 1 million XRP, has documented growth in number throughout the entire recent cycle. Long-term holding wallets sit at all-time highs. Exchange reserves are at multi-year lows. The on-chain story has been structurally bullish the entire time. Retail simply did not have the tools to read it correctly. Now, finally, those tools are emerging. Let's do the math. The kind retail desperately wants to ignore. XRP has a hard cap of 100 billion tokens. Roughly 40 billion remain in escrow under transparent on-chain release rules. 5 to 7 billion are estimated permanently lost to forgotten wallets and abandoned keys. Approximately 800 million XRP are now locked in ETF custodial structures. SBI Holdings has issued instruments redeemable in XRP, creating non-discretionary contractual demand. Evernorth Holdings holds hundreds of millions of XRP as treasury reserves. Strategic reserves, partner allocations, market maker inventory, and long-term institutional holders absorb tens of billions more. The actual freely tradable float is far, far smaller than the headline number suggests. And every clustering analysis run on the live ledger right now confirms that the freely tradable float is shrinking, not growing, month over month. Now layer the demand side. The global cross-border payments market processes roughly $150 trillion every single year. The foreign exchange market alone moves $7.5 trillion every single day. The Bank for International Settlements documents approximately $27 trillion sitting idle in Nostro and Vostro accounts. The derivatives market sits at an estimated $1.2 quadrillion in notional value. if even 0.5% of that idle nostril liquidity migrates to on-chain settlement rails. And the documented research from major central banks suggests that migration is no longer a question of if, but when. The demand against the constrained float is structurally enormous. The clustering data tells you that the institutions already see this math. They are not waiting for the catalyst to begin positioning. They are positioning now in the silence, while retail interprets the surface fingerprint as bearish. This isn't a prediction. It is a documented on-chain machine-verified pattern. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the public ledger and with the analytical tools that read it correctly. Now let me explain something that retail has not yet properly processed about the institutional analytical advantage. The institutional players have been deploying machine learning grade on-chain analytics combined with real-time social media sentiment scanning for years. Their systems correlate retail emotional inflection points, peak fear on social media, viral whale alerts, panic selling spikes, with their own pre-positioned absorption orders. When a viral whale alert hits crypto Twitter at peak retail anxiety, the institutional desks have liquidity pre-positioned to absorb the resulting forced selling at discounts. This is not conspiracy. This is documented, public, regulated trading infrastructure. The asymmetry was never about access to the data. The data was always public. The asymmetry was about the ability to interpret the data at machine speed and act on the interpretation before the retail audience could process what was actually happening. That asymmetry is finally beginning to narrow. AI tools that can perform meaningful on-chain clustering, coinage analysis, and entropy decoding are no longer the exclusive property of institutional desks. They are increasingly accessible to retail analysts, independent researchers, and the more sophisticated end of the retail community. The asymmetry has not been eliminated. Institutions still command larger capital, faster execution infrastructure, and more sophisticated models. But the gap has narrowed from an impossible gulf to a manageable distance. And in markets, narrowing the analytical gap is sometimes the difference between being permanent exit liquidity and being a positioned holder who actually captures the upside when the structural thesis matures. While retail is panic selling at the lows based on misinterpreted surface alerts, the institutional signal has never been louder. Look at what is actually happening, not what is being broadcast on social media. Ripple has spent the last several years deploying over $3 billion in strategic acquisitions, specifically to build the institutional bridge required for whale-tier capital to commit at scale. Mataco for bank-grade custody, Standard Custody for New York regulated trust services, Hidden Road as a prime brokerage clearing trillions annually, Rail for stablecoin-powered payments, G Treasury for Fortune 500 corporate treasury management, Palisade for advanced wallet and custody technology. This is not a startup hoping for adoption. This is the steel and cement of the new financial system being poured while retail panics over a 500 million XRP exchange transfer that, when analyzed properly through clustering and coinage tools, was probably custody rotation between Ripple's own infrastructure providers. Ask yourself this brutal question. Does a firm with the legal exposure of Ripple, after years of litigation against the SEC, deploy over $3 billion in traditional finance acquisitions if the on-chain accumulation pattern that institutional analytics tools are documenting were not real? Absolutely not. They don't gamble. They position. And the people who really matter, the silent actors, are positioning right alongside them, often in the very wallets that retail interprets incorrectly every single week. Look at the broader chessboard. Larry Fink at BlackRock has gone from publicly dismissing crypto to championing tokenization as the future of every financial asset on Earth. Franklin Templeton has launched on-chain money market funds. Fidelity has expanded its digital asset custody operations. JP Morgan continues to deepen blockchain-based settlement work, recently completing a documented cross-border tokenized treasury settlement on the XRP ledger in under 5 seconds. The Bank of Japan, the Japanese FSA, the European Central Bank, the IMF, every serious monetary authority on Earth is publishing on tokenization and on-chain settlement. Every one of these institutions is deploying the exact same kind of AI-powered on-chain analytics we are discussing today. They are not operating blind. They have complete visibility into the ledger's accumulation patterns, and they are positioning accordingly. The retail crowd is staring at whale alerts. The institutions are staring at clustering maps. One of them is going to be very, very right. The other is going to be writing comments on YouTube about how they were lied to. So when does this convergence, the on-chain accumulation pattern, the institutional execution infrastructure, and the AI-powered analytics layer translate into visible market movement? Pay attention here, because the catalysts are no longer theoretical. The Clarity Act and broader market structure legislation moving through the United States Congress represent the immediate regulatory unlock. Once a clear classification framework is locked in, the risk premium that has held back trillions of dollars in compliance-bound capital evaporates overnight. And critically, AI-powered on-chain analytics will detect the institutional positioning shift in the days and weeks before the public price action confirms it. The retail holders who deploy these tools, or who follow analysts who deploy these tools, will see the structural shift before mainstream headlines do. In Asia, Japan's Financial Services Agency has already moved decisively to recognize XRP as a regulated digital asset. The Bank of Japan continues to publish CBDC research that explicitly discusses interoperability layers. The European Union's MiCA regulation is now fully operational. Each one of these developments is another wall coming down between institutional capital and on-chain settlement, and the accumulation footprint that AI analytics tools track will reflect each wall's collapse before retail commentators are even discussing it. Then there is the macro layer. The Federal Reserve continues to evolve its posture. A Fed chair transition is approaching that, by every credible candidate's documented record, points toward a more accommodative stance on payment system modernization. Global debt levels are forcing every major central bank to reconsider settlement architecture. The IMF has openly discussed the need for a more efficient cross-border framework. Layer on top of that the rise of AI agents themselves as autonomous economic actors. AI agents executing deterministic payment logic at scale need ledgers with 3 to 5 second finality and near zero transaction cost. The XRPL is positioned exactly for that workload. And critically, this is the part most retail has not yet processed. AI agents will not just be participants in the demand side of the XRP equation. They will be participants in the analytics side too. The AI deployed to make payment decisions will be the same class of AI reading the ledger to decide where to position liquidity. The market is moving toward a future in which on-chain decision-making is increasingly automated on every side of every transaction. The retail holder who does not begin developing analytical fluency now will find themselves trading against AI counterparties with no defensive interpretation layer of their own. The fuse is already lit. There are multiple fuses. They are lit in parallel. Now let's talk about the side of the equation most people refuse to confront: supply drain. While the demand side is being assembled by ETF custodians, sovereign adjacent institutional partners, treasury vehicles, AI-driven payment flows, and the broader macro liquidity wave, the supply side is being quietly removed from the open market. Exchange reserves of XRP have been trending lower for an extended period. And critically, AI clustering analysis confirms what surface-level metrics only suggest. The entities receiving those tokens are not retail rotating holdings. They are institutional tier wallets with consolidation patterns consistent with multi-year custody intent. Once a token enters a multi-signature institutional vault or an ETF custodian's reserves, it does not come back to market for a 10% profit. It is gone. It is parked. It is reserved for the new system. We are moving from an era of abundance to an era of scarcity, and retail has not priced this in. The clustering data tells you the supply concentration is happening faster than headline metrics suggest. The Age of Coins analysis confirms the tokens being absorbed are held by entities with multi-year time horizons. Every analytical layer converges on the same conclusion. The tradable float is shrinking, the holders are tightening, and the conditions for a violent price discovery event are quietly assembling. Think about what this means in practical terms. When the regulatory switch is flipped, when the macro liquidity wave arrives, when the institutional gates open, the available float on exchanges will be a fraction of what it appears to be on paper today. Order books will be thin, buy walls will be hollow, and the price discovery process will not be gradual. It will be violent. New buyers will not be buying whole XRP. They will be buying drops. 1 XRP equals 1 million drops, and very soon, drops will be the only unit late retail can afford to accumulate. There is a phrase you will start hearing more often: the great priced out. It refers to the moment when retail realizes they can no longer afford whole tokens, only fractions. The window is closing, not in years, in quarters. The institutions have spent half a decade trying to shake you out so they can take your position. And their preferred psychological weapon throughout that period has been the misinterpreted whale alert engineered specifically to extract supply at the worst possible price points for retail. Don't make their job easy. Now let me address the philosophical objection that some in the community raise about AI itself. Many people in the XRP ecosystem are rightfully concerned about AI. They see it as a threat to privacy, a tool for institutional manipulation, an erosion of the level playing field. Those concerns are not wrong. AI is genuinely a powerful technology, and powerful technologies have always been deployed first by the entities with the most resources. But the answer to institutions are using AI against retail is not retail should not use AI. The answer is exactly the opposite. If institutions are deploying high-frequency trading bots and AI-powered analytics to extract value from retail confusion, then retail must deploy its own AI-powered defensive tools to see through that extraction strategy. The asymmetry is the problem. The solution is narrowing the asymmetry, not refusing to participate in it. AI is not your enemy in this market. AI deployed by institutions against the analytically unequipped is your enemy. AI deployed by you or by analysts you trust to read the ledger correctly is your defensive shield. I know exactly what you're feeling right now. You're watching red candles. You're reading whale alerts that flash across your timeline at the most psychologically vulnerable moments. You're seeing influencers pivot to whatever shiny narrative is trending this week. And the temptation to give up, to act on the surface noise of a single misinterpreted transaction, has never been louder. I understand that. But my job is to help you distinguish between noise and signal. Surface level whale alerts are noise. The clustering, age, and entropy patterns underneath them are signal. None of the underlying institutional accumulation stopped because the price went sideways. AI-powered analytics confirm that it accelerated. Being early feels exactly like being wrong, right up until the moment reality catches up. That is the cruelest psychological trap in this entire industry, and the institutions know it. They are counting on it. They need a steady stream of exit liquidity from the confused to fund the entry of the informed. The market is, as the old saying goes, a device for transferring money from the impatient to the patient. But in 2026, it is increasingly also a device for transferring money from the analytically unequipped to the analytically equipped. The question is which side of that transaction you sit on. The question is not whether the price will recover. The question is who will still be holding the position when the on-chain accumulation pattern that AI tools are documenting today translates into the visible price action of tomorrow. If you've made it this far in the video, you are not the confused. You are the informed. Hold that line, because the on-chain ledger never lies. It just requires the right tools to be heard correctly. And those tools, finally, after years of institutional monopoly on analytical interpretation, are coming into the hands of the retail community. The whales have the billions. AI gives the rest of us the vision. That asymmetry, narrowed even slightly, is enough to change the outcome of how this cycle plays out for the retail holders who choose to deploy the tools rather than fight against them. Let me leave you with this. Surface whale alerts are a distraction. Structural interpretation is the reality. One is a screenshot. The other is a multidimensional map of who is actually accumulating, who is actually distributing, and what the silent intent of every major wallet on the ledger really is. The question is, are you watching the surface, or are you watching the architecture? History does not reward comfort. It rewards those who pay attention when the room is quiet, and who have the analytical tools to hear what the quiet room is actually saying. Right now, the room is very, very quiet, exactly the way the silent actors building positions through obfuscated wallet networks need it to be. If you made it to the end of this analysis, drop the word clarity in the comments. I want to see who actually understood what was decoded today. If you value this kind of deep structural breakdown, subscribe and turn on notifications, because the catalysts are accelerating. The math doesn't lie, the ledger doesn't lie, and the system is almost complete. Stay vigilant, stay informed, and as we always do, we don't wait for the future, we plan for it. This content is for informational and educational purposes only and is not financial advice. Always do your own research before making any investment decision.